everyone. Hello. Thank you for joining us this evening. I'd like to welcome you to our annual Spring Education Policy Workshop series at the Bush School. This event is being sponsored by the Mushbacher Institute. My name is Dr. Kalina Cortez, and I'm faculty here at the Bush School. I'll be introducing today's speaker. But first, I would like to give you some background on our Education Policy series. Our series was launched in 2016, and the purpose is to bring in prominent scholars who are working on timely education and policy relevant topics. Our previous speakers include Doug Harris from Tulane University, Amy Ellen Schwartz from Syracuse University, Susanna Lowe from Brown University, Sue Donarski from University of Michigan, and last year we had the honor of hosting Tom Dee from Stanford University. Today, we're absolutely thrilled to bring to you Dr. Matthew Chingos. Dr. Chingos is Vice President for Education Data and Policy at the Urban Institute. At the Urban Institute, he leads a team of scholars who undertake policy-relevant research on issues from pre-kindergarten to higher education. Dr. Chingos has authored multiple articles, and he's also co-authored many books. Among those is The Game of Loans, The Rhetoric and Reality of Student Debt, and Crossing the Finish Line, Completing College at America's Public Universities. He has also testified before Congress, and his work has been featured in media outlets such as the New York Times, the Washington Post, and National Public Radio. Before joining the Urban Institute, Dr. Chingos was Senior Fellow at the Brookings Institution. He received his bachelor's degree in Government and Economics and PhD in Government from Harvard University. So without further ado, I would like to introduce our speaker, Dr. Chingos from the Urban Institute. Thank you.
Great. Well, thank you, Kalina and Lori, for inviting me, and thank all of you for attending tonight. If we were in person in some big auditorium, I could drone on for an hour and you'd have no choice but to sort of sit there and listen to me. But on Zoom, I know I have to compete with your emails, with your kids, and maybe even with your Twitter feeds. So I'm going to try and keep my remarks relatively brief and leave plenty of time for questions. So I'm sure everyone attending tonight is aware there's a lot of student loan debt in this country. About $1.6 trillion in student loan debt outstanding, and almost all of it is held by the federal government, not by private banks. And this is an amount that has roughly doubled over the last decade. And it's now the second biggest category of debt behind only mortgages. And you can see just 10 years ago, it was less than auto loans and credit card debt, and now it is more. But student loans are not like other kinds of debt that you may be familiar with. Student loans don't buy a tangible thing that a bank can foreclose on. The bank can take your car, the bank can take your house, but the bank cannot take your college degree. Second, they're almost entirely made by the federal government, not by private banks. 90% of student loans are made by the federal government to students. And student loans are available to pretty much any college student who wants one. They don't require any proof that the borrower will be able to pay it back, like you'd see for a mortgage or a car loan or other kinds of credit. And that's a feature, not a bug, of the lending program. The whole point of student loans is to provide access to educational opportunities that wouldn't exist in the private market. And the amount of outstanding student debt we see, as I said, now over 1.6 trillion, is the result of three main factors. First, how much federal policy allows students to borrow. That's determined by Congress and the president. Second, how many students go to college and how much they decide to borrow. And third, how quickly borrowers repay their loans after they leave college. Because that 1.6 trillion number, it's how much people currently owe, how much they borrowed and have not yet paid back. And with few exceptions, the trend in policy made by the federal government is to allow more students to take out loans, and in some cases, much bigger loans. So I'll do a very brief history of the student loan program. You might also all be interested to know that it originated with a Texan, President Lyndon B. Johnson, apparently had I think a car repossessed that he was trying to hide from the bank. back when he was in college, a long time ago, when he became president, we started kind of an experiment with student loans. And that little experiment has grown quite a lot. And some sort of recent history that's mattered a lot for how many loans are out there is one change in the early 1990s when Congress opened up student loans to anyone who wanted one, regardless of income. You used to be able to have to show that you had some measure of need, that you didn't have enough money to pay for college out of pocket. And Congress got rid of that limitation and said anyone who wants a student loan could have one. And that was about 1992. You can see on my chart there, pretty much student loans sort of zoomed up right after that limitation was taken away. Another important, more recent policy change was around 2005, when a program called Grad Plus was created. And what that program did was it went from a world in which graduate students could borrow, but could only borrow limited amounts, to a world in which graduate students could borrow essentially unlimited amounts. Basically anything the school was charging for tuition, room and board, any of those fees could now be put on a federal loan, no questions asked. And as you can see, that was also followed by an increase in the amount of lending that happened. And I'll talk a bit more about that in my remarks. But in recent years, students are actually borrowing less than they used to. For undergraduate students, borrowing per student is down about 40% since 2009. So all the rhetoric out there is about student loans exploding, and the overall amount has gone up, but the amount of new loans being made each year has actually gone down. This means that the federal government is dispersing fewer loans, with annual debt issued to undergraduates falling from 70 billion to less than 40 billion over about the last decade. And you'll see on this chart that lending to graduate students and to parents of undergraduate students through other programs has held steady. And I'm going to talk about that in a bit because the story really differs depending on how you look at it. So the fact that student loan debt overall has continued to climb, even as the amount of new loans has fallen, it means that college students are repaying their loans more slowly than today's students are taking out their loans. So in other words, some of the problems with student loans may be more on the repayment side than the lending side. And I'm going to talk about both of those tonight. So if I'm going to succeed at convincing you of one main point tonight, it's this. It's that student loans are not all the same. Student loans are not a single monolithic problem in need of a single one-size-fits-all solution. And the biggest division between college debt, the biggest division in student loans is between debt for undergraduate college students and for graduate school, which are very different. Borrowing for graduate student is more than 5 times that of borrowing for undergraduate. In fact, more than 80% of college graduates leave school with less than $40,000 in debt. So you can see over the last 20 years or so, as undergraduate students, they have borrowed more, but still 29% of bachelor's degree recipients are leaving with no debt at all. And only 19%, less than 1 in 5, are leaving with more than $40,000 in debt. So the typical borrowing of an undergraduate student is about $30,000. And the reason for this is that the federal government puts in place pretty strict limits. So it's hard if you're leaving college to leave with a whole lot of debt. The only way you could do that is if you went to the private market. But graduate students is a completely different story. As I mentioned before, since 2005, graduate students have been able to borrow as much as they want to. And many more borrow large amounts. So what you see in this chart is that 35% of master's degree recipients borrow more than $50,000. And 63% of professional doctoral degrees, think about doctors and lawyers here, borrow more than $100,000. So undergraduate versus graduate, that's one big distinction. Another area of differential impacts that's really important that I want to spend some time on is the racially disparate impact of student loans, the differences we see in both lending and outcomes by race and ethnicity. And if you look at the data, what you see is that Black students borrow significantly more on average than white, Hispanic, and Asian students. And long-standing racial wealth gaps help to explain both these borrowing patterns and why they're especially troublesome. Students from families with less wealth are more likely to need to borrow because they don't have that family wealth to draw on when they go to college. And indeed, the data show that Black students and their parents are more likely to borrow at every income level. In other words, these differences by race don't just reflect differences by income, but also differences in family wealth. So you can see in this chart throughout the income distribution, whether it's lower income families, you see 55% of the lowest income Black families borrowing for college, compared to 43% of the lowest income white families. You move to the middle of the income distribution, you move to relatively affluent families, and you see that difference throughout. And borrowers who don't have access to family wealth, it doesn't just mean they need to borrow more in the first place. It also means they don't have the same kind of a safety net to fall back on when they leave college and maybe have some struggles with repayment as they get their first job or don't get their first job. And what the data should tell us is that nearly half of Black borrowers default on their student loans within 12 years of leaving college. And if you actually look at the data even closer, you see that Black college graduates are more likely to default on their student loans than white college dropouts. So even completing the degree, which we know makes a big difference, doesn't make up for the racial disparity in the default rates. Now, of course, race is not the only factor associated with different student loan default rates. For-profit colleges have long had the highest default rates and graduate students the lowest. So you look over the last 30 years, this chart only goes through 2009. You see the default rates go up and down, partly as the economy gets stronger and weaker. But for-profits have always had the highest default rates, going as high as over 60% in the late 80s and early 90s. And then heading into the Great Recession, back up to close to 50%, where students who just borrow for graduate school tend to default at the lowest rates. And then in other colleges, you see more selective colleges tend to have lower default rates, and less selective colleges, higher default rates. Now, remember that graduate students also borrow the most. This is part of a broader pattern that borrowing more is not generally associated with a higher likelihood of default. So earlier I showed you graduate students borrowing $100,000. You might say, oh, we should be really worried about that. And there are some graduate students we should be worried about. But all in all, they tend to do okay with their loans, I think in a lot of cases, because they get graduate degrees, which are well rewarded in the economy. Where students who take on small amounts of debt often struggle the most, in many cases because they leave college before earning any degree. Only 58% of students who start at a four-year college earn a bachelor's degree from any institution within 6 years. And for community colleges, the completion rate is a paltry 26%. Now, students who struggle with their loans often face other forms of financial distress before they even start trying to repay their student loans, such as they have utilities debt or medical debt in collections. This raises a broader question. Are student loans good debt, like a mortgage or a car loan in good standing, or a credit card that earns you travel reward points, but you pay it off every month, so you never pay any interest to the credit card company? Or are student loans bad debt, like an underwater mortgage, a car that's about to be repossessed, or a high interest payday loan? The answer is that it really depends, both on the amount of debt and the income available to repay it. For the typical borrower, payments have remained at an affordable share of income, less than 10%. So you can look from 1992 to 2003, you can look at the mean, the median, however you want to slice the data. The burden of student loans in terms of how much the payments are as a share of your income hasn't really gone up very much. In fact, it's stayed relatively flat. In some cases, because people are paying their loans off over a longer period of time, but there doesn't seem to be a greater short-term burden. In fact, having more debt is associated with having a higher income, because those who stay in college long enough to earn a degree and the additional income that comes with that degree tend to borrow more, as do graduate degree holders. And if we look overall at the data, what we see is the 20% of households with the highest incomes, the top quintile of the income distribution. That 20% of households holds 26% of student debt and makes 39% of monthly payments. So if you look for where student loans are, you might think, oh, it's lower income people have student loans because you needed to borrow to go to college. It's actually higher income people, because going to college on average leads to better earnings. So having that student debt is actually, for a lot of pieces, a marker of privilege, a marker of advantage, not a marker of struggle or disadvantage. And if we look at graduate degree holders, they're only 26% of all student loan borrowers, but hold nearly half of all the outstanding student loan debt. So once again, graduate students borrowing big amounts means that a lot of relatively advantaged people in the economy, people who include doctors and lawyers and other professionals, make good incomes, borrow a lot of money, but in many cases can pay it off. And that's the sort of rosy side of the story. That's the part that's not always told that much. Of course, we're all familiar. That's not true for everyone. Just because a college degree pays off on average doesn't mean it pays off for everyone. And we know that many borrowers fall behind on their payments and default on their student loans, sometimes relatively quickly after leaving college. For example, what this chart shows you is that borrowers who started repaying their loans in 2012, fewer than half were still current on their loans 4 years later. So many borrowers are falling behind quickly and defaulting on their loans, which is when they basically haven't made any payments for more than a year. And defaulting on your student loans is a bad outcome. It hurts your credit, lowers your credit score, makes it harder to access other kinds of debt you might want, like to buy a car or a house. And it can lead to some pretty severe consequences. It can lead to your employer garnishing your wages, which obviously takes your money away and can be embarrassing. And it can lead to the IRS taking your tax refund. So you think you have a tax refund coming back, and the IRS takes it to pay your student loans. And if you're a low-income working family who relies on the benefit of the earned income tax credit to get by, you may find tax time comes around, you don't get your EITC because the government has taken it away to pay back your student loans. So defaulting on your student loans is a bad outcome that policymakers should work hard to avoid. The key question for policymakers is how to reduce the amount of bad debt, help borrowers who are struggling to repay, while more or less leaving alone borrowers who are doing just fine. So how do we fix the system going forward to avoid the problems that plague so many borrowers today? Before getting into possible policy solutions, I think it's important to articulate some of the principles that underlie the recommendations I'm going to offer, and I'm happy to discuss when we get into the questions. First, the system should be simple enough for borrowers to understand and navigate, and for the government and services to administer. One of the big problems with our current system is it's tremendously complicated. There's so many different repayment plans, different kinds of loans. It's confusing for borrowers to figure out, but it's also often confusing for the servicers to figure out. So you call your servicer for help, and sometimes they don't understand the loan program. Sometimes as a researcher, someone who has, I think, some expertise about this issue, I can't understand what these programs are trying to do because they're so complicated. Second, policymakers should adopt forward-looking policies that affect future students and backward-looking policies which affect previous students that make sense together. For example, maybe we want to forgive this debt of students who attended low-value institutions who got ripped off. At the same time, if we're going to do that, we should stop making loans for students to go to those same institutions. We shouldn't do just one and not the other. So in all the talk we have these days about student loan forgiveness, I think it's important to think about what do we do with the people who have debt now, but also what do we do with the people who are going to have debt tomorrow? If we don't think certain loans should be made, maybe we want to forgive those, but then we should stop making the loans. We shouldn't forgive debt with one hand and then go back to making the same loans on the same terms with the other hand. Third, it's my view that loans should be loans and grants should be grants. We should never run loan programs as a backdoor grant program. For example, letting students borrow lots of money we never know they're going to repay and telling them up front, oh, don't worry about it, we'll forgive it. That's really no way to run a bank, much less a major federal program. If we do it that way, we make it loans a backdoor grant program, we're just hiding subsidies that will be better provided as upfront grants that reduce the prices students pay. So if we're going to use a lot of taxpayer money to help students go to college, and I happen to think that's a good idea and we should do that, we shouldn't hide those grants in loan programs. We should give them up front and give people grants or more grants than we do today to help them afford college. Fourth, I think we need protections in place that make delinquency and default unlikely, especially for vulnerable borrowers. We currently have millions of borrowers in default on their student loans. It's bad for them, it's bad for the country. I think we should make it a priority to address that. And fifth, I think reforms should make a special effort to mitigate the racially disparate impact of the student loan program, especially the student loan crisis among Black borrowers that I highlighted before and showed you some of the troubling statistics about. So I'm going to start with some ideas for how we could fix the repayment side of student loans going forward, thinking about new borrowers, the loans that are going to get made tomorrow. I think a big improvement would be to automatically tie payments to income. Borrowers already have this option. There's something called income-driven repayment, where instead of just paying a flat amount on your loans every month for 10 years, which may not be affordable for you, you can pay 10% of your discretionary income. So you take your income you make in a year, you subtract off 150% of the federal poverty level. So for a single individual, that would be subtract off something like $18,000. So if you made $30,000 that year, subtract off $18,000, take $12,000, you're going to pay 10% of that on a monthly basis. And you're going to make those payments. If your income goes up, you'll pay more. If your income goes down, you'll pay less. You make those payments for about 20 years, and then any remaining amount will be forgiven. So we already have this thing called income-driven repayment, but it's very complicated. It requires navigating all these different plans with different rules, and requires filing new paperwork every year. If you don't file that paperwork, you get kicked out and get put on your old flat payments every year for 10 years. You can't afford that, you go into default. So instead, I believe we should make this paying your student loans based on income. It should be automatic. You shouldn't have to sign up for it. It should be something that everyone can participate in without even having to ask. And if you want to make it be done in 10 years, you can ask for that. We could even go a step further, and we could collect the loan payments along with income taxes. This is what they do in Australia and in England. So the same way your taxes get withheld from your paycheck every couple of weeks, your student loan payments would get withheld. And that means when you lose your job, you don't go into default on your taxes. You also wouldn't go into default on your student loans. So when you have a big stress like that in your life, there's a big recession or you get laid off, you don't have to worry about stopping your student loan payments or doing anything. It just stops automatically. You don't go into default. And a final change I think we need to make going forward is we need to tie how long you pay your loans under income-driven repayment to the amount you borrowed. The way it works today is you pay 10% of your income for 20 years, regardless of whether you borrowed $1,000, $10,000, or $100,000. In my mind, it would make a lot more sense. If you borrow more, you should pay for longer. Now, a lot of the policy discussion focuses on what happens after students borrow, but I think we also need to pay attention to how much they can borrow in the first place. At one extreme, we could decide that student loans are a failed experiment and end the program and forgive all the debts. Just say, this isn't how we want to pay for college. We should give people more grants. We should let them figure out how to pay for it, go to the private market, whatever. I think it's unlikely politically. I also think it would be a bad idea. I think it would harm many students for whom loans open up educational opportunities. I just mention it because there's all this talk about student loans being bad and we should forgive all of them. So I think we need to seriously engage with the idea that, well, if that's the case, maybe we should stop making the new loans. We shouldn't just forgive the loans, but still keep making them. So I don't think we should end the student loan program. But I think there is a strong case to be made for reducing loans. I don't think there's a case to be made for reducing the limits for undergraduate students. As I showed you before, undergraduate students, for the most part, are borrowing relatively reasonable amounts. But for graduate students who can borrow as much as they want, including to go to programs that often may not pay off, we could go back to those limits we had in place before 2005. The downside of that it would push a lot of students to the private market, and it might reduce access to students who could not get a loan there. That could be good for some students if the private market's saying you shouldn't borrow $100,000 to get a degree that's not going to pay off for you, whereas someone else, we are going to make the loan because we think it's going to pay off. That could be some good market discipline, but it could also reduce access for students who don't have a strong credit history or don't come from a wealthy family, and I think that would be undesirable. I think we also need to take a close look at loans to parents. I kind of mentioned this before, that we're also lending something like $10 billion a year to the parents of undergraduate students. The problem with this program is there's very little credit check that happens. So a lot of these loans are going to families below the poverty level, families with very little income who have no hope of repaying the loan, but just want what's best for their children. So their child wants to go to a college and the college is telling them, hey, you can get this loan from the government. So I don't blame them for doing what's best for their child and providing that opportunity. But I think that's a predatory lending program that the federal government's running at the expense of these parents, and it really needs to be reformed. Of course, we can't just fix the problems with student loans for future borrowers. We have to help those who are struggling today. Income-based repayment programs, which I told you about earlier, they make loan payments affordable in theory. But as I also told you about, they haven't worked well in practice. Income-driven repayment gets the basic idea right, but you should only pay what you can afford. But they need to be implemented much better. One example of that is I think it's ridiculous to make borrowers with very low incomes prove they are poor for 20 years in order to get forgiveness. Say you go to college, you drop out after a semester or a year with a few credits. It didn't work out for you. You didn't have a good experience. It has very little value to you in the labor market. You struggle in the economy after that. Should we really make you fill out paperwork every year for 20 years just to finally get that loan forgiven after 20 years when you never could have repaid it in the first place? I think we should forgive those loans more quickly if possible. I think we should also forgive loans that never should have been made, such as to attend low quality programs, right? If there are colleges where the graduation rate is 10%, or the student loan default rate is 60%, or almost everyone who goes there is just very unlikely to ever succeed in the labor market and maybe even to get a degree from that place. We shouldn't make loans to go to those places in the future. And the loans that were made to go to those places in the past, we should say that was a mistake. Our bad. Let's forgive those loans. I could also imagine using a modest amount of forgiveness universally as an incentive to get borrowers into a new repayment plan. So I mentioned before, we have to think a little bit differently about going forward versus looking backward. And part of the issue there is if we're going to have a new plan going forward that works better overall and is a better designed program, but for some individual borrowers, might cost them something. It might be a slightly less better deal. We can't force them to take that new deal. But perhaps we could offer, say, $5,000 to every borrower as an incentive to get into a new repayment program that's going to work better for the system. So I want to conclude my talk by returning to the one point I want you to take away from my talk, which is that student loans are not all the same. We could move to a system where they are much more the same. We could eliminate the graduate lending. We could only lend limited amounts to undergraduates. And if that was the case, we could have more similar policies for everyone. Everyone could pay their loans off in 10 years. We could be much more generous with forgiveness. We could have lower interest rates, all those kinds of things that would be much easier if everyone was kind of more in the same boat. Or we could try and keep this more diverse system we have now that includes graduate students with lots of borrowing and people who go to community college and borrow much less. And we could try and refine and reform that complicated system we have and move to another system, which is still going to be fairly complicated if we want it to make sense, both for a college dropout with $5,000 in debt and a doctor with $200,000 in debt. But the thing is, we can't have it both ways. We have to sort of choose one path or the other if this student lending program we have in this country is going to do more good and less harm for our students. So I appreciate your attention and look forward to your questions. Thank you.
Thank you very much, Professor Chingos. That was absolutely wonderful. So assume that there is large amounts of applause kind of going along with my small amount of applause here on the panel. My name is Lori Taylor. I'm a professor at the Bush School of Government and Public Service and one of your hosts this evening, and absolutely thrilled that you were able to come and talk to us about an issue that's incredibly timely for our students. We asked the audience, and I'm sure that your comments have provoked a lot of very interesting questions. So if you have questions out there on Zoom, there's a question and answer option for you. You could type them in and I'd be glad to share them with Dr. Chingos if we have time. We also have some questions that we collected in advance at the time that people indicated that they were going to RSVP for your talk. So I'd like to ask a few of those questions for you now. One of the first questions I wanted to ask is, one of our audience members asked, how realistic is President Biden's goal to relieve all students of $10,000 worth of their student loan debt? And how realistic financially are those larger estimates for relief on student loan debt?
Well, in terms of the political feasibility, there's some folks out there, including the Senate Majority Leader Chuck Schumer, who've argued that the president has the unilateral authority to just forgive any amount of student loans. Senators Schumer and Warren have encouraged the president to forgive up to $50,000. That's a debatable point. Folks disagree on whether the president actually has that authority. There's some language in the law creating the student loan program that you could read that way, but it seems unlikely that Congress intended for the president or Secretary of Education to just go and sort of willy-nilly start forgiving loans. What President Biden has told us so far is that he wants to work with Congress. He wants to work with Congress to pass a law that would forgive $10,000 in debt for each borrower. So far, we haven't seen any movement on that. There's a COVID relief package moving through Congress right now, and that could have potentially been a vehicle to do that, but they have not decided to do that. So it doesn't seem likely to happen anytime soon, but it's possible that as negotiations with Congress move on, perhaps in 6 months or a year, the president's position might change and he might decide to try and do something unilaterally.
Okay. So what would be your response if people essentially said that loan forgiveness is unfair to those who did not pay for college or did not attend college? That it's essentially redistributive from those who pay taxes to those who go to college on student loans?
Yeah, I mean, there's been a lot of discussion about the distributional impacts of forgiving student loans. And as I mentioned in my talk, if you look at who holds student loans, it tends to be, on average, a lot of higher income people because going to college provides economic benefits. There's different ways that people argue about some of these distributional kinds of analyses. Obviously, if you went and put a tax on millionaires and billionaires and used it to forgive student loans, you'd be doing some downward redistribution. So if you think of it as just sort of compared to everybody, yeah, focusing a policy on people who went to college is going to, on average, benefit people who are relatively more advantaged. I don't think that's a reason on its own to oppose it. I mean, if you think that a lot of these student loans, no student loan ever should have been made, well, they happen to be taken by people who went to college, we should do something about that. But as sort of pure kind of distributive policy, there's certainly more progressive things you could do, right? You could forgive student loans just of lower income people. You could send everybody a check for $10,000. You could send lower income families a check for $10,000. And all of those things would be more progressive than forgiving a significant amount of student loan debt for everyone, because there's a significant chunk of the student loans that are held by relatively higher income people.
Great, thanks. So there's a literature out there that argues that the easy availability of student loans has led to an increasing level of tuition for a variety of universities, and has made it possible for state governments to cut back on their financial support for institutions of higher education. Do you buy that argument? And does that play into your solutions at all?
I mean, I think there's a certain plausibility to the theory, right? If you make it easier to raise prices, maybe colleges will be more likely to raise prices. And my understanding of the literature is that there's some evidence for it here and there, especially in the for-profit sector, which is, as we'd expect, more kind of market driven, whereas prices especially in public colleges and universities, are set by a range of factors. So sure, students are definitely getting squeezed when it comes to public tuition, because the state legislature, if they have a budget crunch, they can't ask their prisoners to pay more money, right? They can't ask people getting health insurance for low-income people to pay more money, but they can't ask college students to pay more money. But that's a sort of political process that involves so many different factors. I think it's harder to draw a line from we have student loans available to we're just going to go ahead and raise the prices. So I don't think that's the main factor driving the increase in prices. But I think in part because for undergraduates, the loan limits are relatively modest, so you can't just raise tuition forever. For graduate school, I'd be a little bit more worried about it, this sort of unlimited borrowing. We have seen instances of, some law schools, telling their students, if you're planning to go into public service, borrow as much as you want, and it's all going to get forgiven. Because if you work in the quarter of the economy that's either a nonprofit or government, you actually get your loans forgiven after 10 years. You have to jump through a bunch of complicated hoops. It's not a well-designed or well-implemented program, but it's potentially a much more generous program. So a lot of the problems from the kind of fiscal policy side we're going to see, I think, with student loans to graduate students isn't that they're borrowing a ton and then can't repay it. It's that they borrow a ton and then are eligible for these forgiveness programs. And that could be a way that a lot of public dollars can end up flowing to relatively affluent people.
Cool. So one of our respondents wants, what's the difference in implications of student loan debt at public versus for-profit institutions versus nonprofit institutions like a Harvard? Should it matter whether your student loan debt is from a state university or a private university?
I don't think it should matter where your student loans are from. From a sort of policy perspective, you should be concerned about the value the institution provided for the student. And regardless of what college you went to, if that college prepared you to succeed in the labor market, well, then hopefully for most students, their loan would be affordable to pay that loan, be an investment they could feel good about. Now, if it's a college where they got a lousy service and maybe never even got a degree and are not succeeded in the labor market, that's a problem. It's a problem for the student. It's a problem for taxpayers who now are going to be holding the bag for that loan. And what we see in the for-profit sector is the share of people who struggle to pay their loans, and in many cases default, is much higher than other sectors. Doesn't mean that every for-profit college is a bad college. Of course, there's some that are doing just fine. And it doesn't mean that every public and every private nonprofit college is doing a great job, because we see parts of those sectors that struggle as well. So those patterns are important to think about for policymakers, especially on the for-profit side, where you worry that maybe there's sort of too much, market pressure to take advantage of what's basically not a free market, right? A government program that's providing these dollars.
Mm-hmm. So if we took your advice and we basically said, look, these seem to have been a predatory loan. This looks like an institution where the default rates are really high. We are going to forgive loans to those institutions and not make any new loans to those predatory institutions. Where do we draw the line? What's the default rate, or how do we decide what's the default rate that is acceptable and what's the default rate that's unacceptable?
I think that's a great question, and it's really hard to draw those bright lines. I think it's pretty clear that right now the regulation is too loose, that given where the default rates are, and there's colleges where, even setting aside the default rates, where the majority of students coming out of those colleges are earning wages below the poverty level. And a lot of folks say, well, we shouldn't just think about earnings as the only outcome from higher education. I completely agree, right? I think it's fine that some people become engineers and make good money, and some people become teachers or social workers or poets and do socially valuable work but make less money. That's completely fine. But no one goes to college saying, I'm going to go to college and come out and live below the poverty level. So if we see colleges where that number is really high, I think it shouldn't be possible to get a federal loan to go to those colleges. So it's not like there's one number that's the perfect number, but I think we do need to get stricter on how we make those loans going forward, and then take a look at the loans we made in the past. If there were some that obviously shouldn't have been made, well, then maybe we shouldn't ask people to repay them. In a lot of cases, those folks aren't going to repay them anyway. So some of that forgiveness can be done at little cost to taxpayers, because you're basically looking at loans that people don't have the income to repay. If people were participating in income-driven repayment, as we hope they would, but too often they don't, they'd be eligible for a zero payment anyway. So some of that I think could be done, and it looks like, hey, we're forgiving $20 billion in student loan debt, but if 15 billion of that would have never been repaid anyway, well, you haven't spent 20 billion, you spent 5.
Cool. So I think I remembered your statistics right, that community colleges tend to have really elevated default rates. If that's true, would some of the proposals you're putting forward have a disproportionate impact on the community college systems?
You know, that's a great question. The interesting thing about community colleges, and the sort of important contextual factor, it's true that the default rates do tend to be not quite as high as for-profits, but relatively high. But very few students actually borrow, who go to community college actually borrow. Because community colleges, the prices tend to be low. The federal Pell Grant program for low-income students, and a lot of students at community colleges are low-income students, more than covers the tuition. So for the typical community college student, it's tuition free, and they're actually getting a refund to help with their living expenses while they go to college. So very few students who go to community college take on a federal loan. Among the small number that do, the default rates are relatively high. So I think what you need to think about in an accountability system when you're trying to deal with some of these issues is it's a pretty big difference from a for-profit college where 90% of the students borrow and 30% of them default, and a community college where 10% of students borrow and 30% of the 10% default, right? That's 3% versus 30% that are actually defaulting as a share of all the students at the college. So you have to interpret those with a different lens, and then policymakers who are looking to do something about this shouldn't just look at the default rate. You also have to take into account the number of students that are borrowing in the first place.
Okay, cool. So why do you think it's been so difficult for the policymakers to deal with this problem of institutions with a really high default rate?
I think a lot of it's politics, that it's sort of a diffuse social good to stop making, federal loans to colleges where that's not a great idea. And the diffuse public doesn't have a lobbyist in Washington pushing for that. Whereas those colleges obviously do have lobbyists in Washington who protect, the financial interests, the same way that public colleges and private nonprofit colleges also have representation. So there's nothing inherently wrong with institutions representing their interests. But I think it's politically different for that reason. But I don't think it's not just about financial self-interest. These students also do provide a service that people at least want, to the extent that they're signing up and going there. And a lot of for-profit colleges, serve a lot of low-income students, a lot of students of color, a lot of students who historically have been and still are disadvantaged and poorly served by the education system. So a lot of the colleges argue we're kind of helping educate a lot of the students who don't have other opportunities, and you shouldn't take that away, and you shouldn't hold these bad outcomes against us. So it's sort of hard to know when you see a college with bad outcomes. Is it because they're giving students who would struggle anyway a fair shot, and it's just not working out for a lot of them because of who they're serving? Or is it because it's truly a lousy service that they're providing in the first place? Or is it sort of a mix of those things?
Okay. So it seems like the quality of the colleges and universities, community colleges, is relevant to this whole debate. So one person from the audience asked, should repaying student loans be based on an individual's measurable knowledge? And depending on what university they went to, should there be some sort of exit exam or other standard for repayment? You didn't learn anything, you don't owe anything?
I think a lot of these kinds of measures you have to worry about gaming, right? If it says, oh, take this test, if you fail the test, you don't have to pay your loans. Well, I know how I'm going to do it on that test, right? But I think the implicit point in the question is well taken, which is that you want to think about the value people are getting out of their education. And, I think right now the best way we'd have to look at that is, well, to what degree is it valued in the labor market? And if we're trying to keep payments affordable for people, I think it's pretty fair to say, anything else you borrow to buy a house or a car, there's a payment you have to make, right? If you can't make it, maybe they'll be nice to you or work with you sometimes, but they can come take the house or the car. I think the policy we have for student loans is actually a pretty fair deal in theory, which is that if you borrow a little or a lot and you struggle with a low income, you don't have to pay, right? You can just pay that 10% of your income, and you even get to subtract off some of your income before you pay the 10%. I think that's basically the right way to make loans affordable for people, and to reflect the fact that some people are going to make higher incomes and get more out of college in terms of value in the labor market than other people who may just get less value out of college, or they may get a lot of value, but just not value that's picked up in the labor market. So I think there's some tweaks that need to be made there. I don't think it should be 10% for everybody, regardless of how much you borrow. But I think that's basically the right approach to sort of, make the payments affordable and have some connection between your performance in the labor market and how much your student loans you pay back.
Okay. So I think you made a very persuasive case that a lot of the problems with the student loan system are at the graduate level. Since all of my students are master's candidates, I, of course, would like you to make a further distinction that it's at the doctoral level or the MD level, which is where all these debts are accumulating. Would you go along with my self-serving interpretation of your data?
I'm not sure I quite go that far. I think just to, on the graduate student side, on one hand, it seems crazy that you can borrow as much as you want to kind of do anything. On the other hand, the repayment rates for graduate students are pretty good. People who get master's degrees and doctoral degrees, I mean, some people obviously struggle, but in a lot of cases, people are able to get pretty good jobs. I think the problem with those really intersects with these forgiveness provisions that are getting more and more generous. If you have to pay 10% of your income for 20 years, if you make a good income for at least some of those years, you're probably going to repay at least a bunch of your debt. It's these programs over 10 years that create a lot of problems. I think it's especially a problem for doctors, because doctors have those years of residency when they don't make very much money. So if you're at a nonprofit hospital, you do your residency for 4 years and an internship and a few other things, you get pretty close to the 10 years, you pay for a couple of years, you get a huge amount of debt wiped out. If you're a doctor at a for-profit hospital, you don't get that. So there's also some other kind of funny unfairnesses, like arbitrary distinctions, right? If you're a journalist at the Washington Post, you're not eligible for the public forgiveness after 10 years. If you're a journalist at NPR, you are. And is there really a social difference between the value created by the Washington Post and NPR? I don't think there is. I think they're both great publications who are doing a public service. So I think that those are some of those distinctions are sort of the bigger issue. And in terms of the actual programs, I think I would go more program by program than classes of programs. But I'm happy to say I'm sure the master's programs at the Bush School are fantastic and worth every penny.
Yeah, we will be using that in our advertisements from here on out, for sure. So in thinking about the situation that we have right now, with so much of the student loan debt amongst individuals who are in a good position to pay things off if the economy is doing well. I have to think about the people who are looking at the COVID-19 pandemic as a predicted shortage of physicians. If we were to take action on student loan debt, would that leave us with fewer people going into medicine?
Say that again. You're concerned that if...
The question is, given the COVID-19 pandemic and the predicted shortage of physicians, do you think that there will be some policy to relieve the debt burden for medical students and those in other high demand fields, or do we already have that policy? Well,
if you're working in a nonprofit, hospital or other medical provider, you already get this forgiveness after 10 years. To the extent it's a doctor shortage, you could imagine other kinds of incentives. But I think there's a kind of a broader point here, which a lot of times people see some social problem they're concerned about, which is we don't have enough doctors. We don't have enough doctors in rural areas. We don't have enough teachers. We don't have the right kinds of teachers. We don't have enough social workers. And their solution to those is let's do something with people's student loans. Let's forgive a little bit of their student loans or give them a better interest rate or due less time to forgiveness. I think it would make a lot more sense to just address those problems directly. Right? If we need more doctors, well, let's think about how do we have more spots in medical schools? If we want more doctors in rural areas, how do we pay more folks, more doctors to go work in rural areas? If we want more teachers, maybe we need to pay them more. And I think it just makes a lot more sense. It's economically efficient approach to solve those problems by targeting them directly, not trying to go through some backdoor loan program. Because if you want more doctors in rural areas, pay them more. Don't say, well, you can get paid more to be a doctor in a rural area, but only if you have student loans that you haven't paid off yet. And the more you borrow, the bigger of a incentive payment we can give you to go in the rural area. The other thing I'd like to say about the COVID-19 crisis is that student loan payments and interest have actually been suspended for almost coming up on a year now, right? At the beginning of the crisis, first, the Trump administration acted by executive action, and then Congress followed up with a law that paused student loan payments at the end of September. The Trump administration continued that till the end of January. The Biden administration has now announced they're continuing that till the end of September. So unless you really want to be repaying your loans, and it doesn't really make any sense to because no interest is accumulating. So basically the 1.6 trillion is now one big interest-free loan from last March to the end of this September, at which point people will be expected to resume their payments. So it's a new strategy that had never been tried before, which is in the context of a public health crisis, but also an economic crisis, to press pause on student loans. So I think that's really going to set up some challenges for how we restart that machine, right? It's like we stopped the Titanic, and now we got to get the engines going again. And I think there could be some bumps in the road. But it also sets an interesting precedent for could this be an effective way in future economic crises to sort of help people not have to worry about struggling with their loans. I think a system like where you pay automatically based on your income would be a better, more flexible system. Because an economic crisis happens, 20% of people are unemployed, they stop making payments, the other 80% can keep paying. It's obviously a pretty blunt instrument to turn everyone's payments off. But in a system as sort of poorly implemented and complicated as ours, you can see why that would make sense rather than trying to do it in a more targeted way.
You just used a couple of really important words, poorly implemented and complicated. Why is the system so poorly implemented and complicated? Is this a deliberate ordeal mechanism to prevent certain people from having access?
I don't think it's deliberate. And I think it's poorly implemented because it's complicated. And it's become more poorly implemented because it's so complicated. And I think the complications all come from good intentions, right? So the student loan program starts as an experiment in the 1950s, then gets expanded under Lyndon Johnson in the 60s. It gets expanded and expanded. And Congress adds new loan programs. So there's actually, for undergraduates, there's two different loan programs or kinds of loans. You can get a subsidized loan and an unsubsidized loan. Both are actually subsidized by the government, but the subsidized one is extra subsidized because interest doesn't accrue while you're in college. So you borrow $10,000 in subsidized loans. When you graduate from college, you owe $10,000. You borrow $10,000 in unsubsidized loans, you're going to owe probably another $1,000 or $2,000 more than that when you leave because of the interest that's accrued. Then for graduate students, they can get the unsubsidized loans and they can get these grad plus loans that carry a higher interest rate. Then you have the loan to parents. Those are just different kinds of loans. Then on top of that, you have all these different repayment plans. So there's that the public service loan forgiveness program I mentioned. That was actually only created to cover one kind of federal loan called a direct loan, which is the only loan that's been made since 2010. But when it was passed in 2007, it was a small slice of loan. So Congress did that to be cheap. And now there are all these people who had the wrong kind of loan, think they're eligible for all this forgiveness, not getting it. And I can't imagine any of you are actually following everything I'm saying because it's just too many moving parts. So I think where the complication comes from, it's just this accretion of policies that Congress likes to create new programs that help people. And I think individually, these programs, help people, at least help some people, but collectively, they just make up a total mess. So when you have a Congress that likes to create new programs, but never wants to get rid of old programs because there's interests that support those programs, you get into the situation we find ourselves today. So I think there's really, a need for big structural change when it comes to student loans. I think there's really something to be said for, can we wipe the slate clean and start over with sort of one streamlined set of programs that are aimed to accomplish the goals that we have for them.
Okay. So I hear it's complicated. It's an accretion of complications. You had a variety of possible solutions. I wave my magic wand. You're in charge now. which of your solutions do you adopt first?
I think the most important one is letting people pay their loans based on their income and having that happen automatically. You don't have to sign up for it. You don't have to do paperwork every year. I don't go and fill out a tax return to figure out how much money my employer takes out for my taxes. At the end of the year, sometimes there's a little bit of adjustment that has to be made when you do your tax return. But have people student loan payments be the same way. You graduate from college, you get a job, you start paying taxes, you start paying your student loans. At the end of the year, you get a statement, you have to balance some things out. I think that would be the single biggest change that would make a difference for people, because you don't have to rely on them to figure out how to navigate some complicated system. It actually can be very complicated on the back end. All the program rules could be super complicated, but if from the perspective of the borrower, it's super simple and your loan payments just sort of happen. You lose your job, your loan payments stop. That would be, I think, the single biggest change we could make that would follow models that have been tried successfully in other countries like Australia and in England. I think it could work here. It would obviously be a big transition. It would be a big logistical lift to have employers suddenly be collecting people's student loans. But it would work a lot better for people and avoid a lot of the pain and hardship we're seeing.
What do you think about this idea of privatizing the student loan system and putting the private banking sector in charge of making student loans and collecting on those loans?
I think it would be a big mistake. I think there's really there are aspects of the student loan market that could be shifted back to the private market. So in the days when graduate student lending was limited before 2005, if you were, a law student at a fancy law school where everyone knew you were going to make a lot of money, you could go to a private bank and get a loan, and that probably worked out okay. So we could probably privatize some small slices of the market. When we think about the broad access institutions, providing every student with access to affordable undergraduate education, there it's really important that everyone have access to loans. And having the private market make them, it would push a lot of people out of that market. It might give them terms that are much less desirable, especially with income-driven repayment is such an important safety net for students. It seems unlikely that private banks would offer that. There was a version of the student loan program from before 2010 when the government backed the loans, but the banks made them. And some people talk about that as sort of there being some privately run benefit from that. But it was basically just a big form of kind of corporate welfare because the federal government took on all the risk. It guaranteed profits to the banks. And the banks really added very little of value. It wasn't really a public-private partnership. It was corporate welfare from the federal government to the banks. So sometimes you hear Republicans today saying, hey, Obama 2010, they took over the student loans. We should go back to the way it was. And if you actually talk to the people who on the right at the conservative-leaning places who study this issue, they say, no, that's crazy. That wasn't that private market in any real way. That was just a way for these banks to get a lot of free money from the government.
So do you recommend, one of the members asked, do you recommend a minimum income level tied to loan repayment, such as some percentage of the federal poverty level, in your plan for essentially direct withdrawals from the paycheck, just like withholding from the income tax? Would you have a floor on income for eligibility, or would it be only when your income goes to zero do your payments go to zero?
Yeah, I absolutely would support there being some income that's not subject to student loan payments, the same way of income that's not subject to tax. That's a feature of current policy. Under the current income-driven repayment plans, your payments don't start until 150% of the poverty level. There have been some proposals by Democratic members of Congress to raise that up as high as 250%. I think in Australia, the payments don't start until $40,000 or $50,000. You could also make that payment system progressive, right? So like in our tax system, you pay nothing on your first, whatever it is, $10,000, $20,000 of income, then you pay 10%, then you pay 15%, you pay 20%. Under our current policy, you pay 10% above 150% of the poverty level. I think if you borrow less, you should pay either a lower percentage or for less time. If you borrow more, you should pay a higher percentage or for more time. You could also make a case that the first couple dollars of income that you pay should be at a lower rate, and the rate should go up from there. and that would be more progressive. It would also be more affordable for people. So on the campaign trail, President Biden said people should pay 5% of their income toward their student loans. I think just moving the 10% to the 5% is not a great idea because it would provide the biggest benefits to people with the largest debts. They would kind of get more forgiven at the end, and people who are truly struggling, who maybe shouldn't be paying anything, it's just not going to matter for them. But I could see maybe we should say, well, you should pay 5% on your first $10,000 in income over 150% of the poverty line. Then you should pay 7%, then 10%, then maybe 12 or 15 or 20%, and have it go up from there. But I absolutely agree, people shouldn't be paying on their student loans if they're only making poverty or 150% of poverty wages.
So I have a friend who celebrated just paying off their student loans. So did she make a mistake? Should she have waited for a policy change? How do you be equitable to people who've just finished paying when you provide benefits to the people who still have debt?
I think this is why I think it's important to have to have a consistent set of policies around student loans. So, I mean, sure, we could decide the whole thing's a mistake and we're going to wipe it all out, and that's going to be unfair to some people, but we're not going to do that. So if we're going to continue to have a student loan system that looks something like what it looks like now, I think it's important that we send reasonable signals to people. And I'm not sure, your friend may well, from sort of a purely financial perspective, your friend may have made a mistake, right? In 6 months, if President Biden, with or without Congress, forgives everyone's $10,000 in debt, she probably will wish that she had kept the $10,000. Now, in my mind, that's no way to run a program, right? People should kind of go in knowing what the rules are. If in retrospect, we feel like we ripped some people off, made some mistakes, we should fix those mistakes. I'm not saying that fairness is a reason to never fix our mistakes. But for most people, I think we should try and stick to a reasonable set of rules. And one of my concerns with just saying, hey, let's forgive $10,000. I mean, you don't want to be the Scrooge that says people shouldn't get their $10,000. But then what does that say to future borrowers? Does it say don't pay off your loans, like try and hold them so you can get the 10,000? And I think that's why it potentially undermines the program going forward if we're just going to have at random moments a politician comes into office and says, hey, it'll be popular, I'm going to give people some money, how can I do it? I'll forgive some of their student loans. So that's why I think if we are going to do some forgiveness, it's important to do it in a way that makes it really clear this is a one-time thing. We made some mistakes, we're correcting those wrongs. And I think one way to signal that is by making changes that are forward-looking and backward-looking at the same time. So this isn't just random forgiveness that you should hold out for again in the future. This is correcting some set of mistakes we made in the past and that we're also going to correct for future borrowers.
Wonderful. Well, I could keep after you for hours and you'd get tired, but I wouldn't. It'd be grand. But I think I need to wrap it up and tell you thank you very much for such an enlightening, informative, and entertaining evening. We really appreciate you. We wish you could have come to Aggieland. There would have been barbecue and Tex-Mex and Bush School bling. And we will be sending the bling, but the barbecue doesn't travel well, so we're eating it on your behalf. But thank you very much for this wonderful presentation.
Well, thank you for having me, and thank you to the audience for all the terrific questions. Really appreciate them.
So thank you all. Have a good evening. I don't need to tell you all to drive safely on your way home. Hopefully you're already there. So good night.